Every bond has special terms and conditions stipulated in the bond prospectus. This document. Kenyans are used to long-term bonds with only one redemption date. And the redemption date is the date when the Central Bank of Kenya pays back your principal amount in full. However, the 2022 infrastructure bond has two terms and conditions that people seem not to understand, and I've been receiving a lot of questions from the Wealth Tribe. You need to understand these two conditions before you invest. And these two conditions are the redemption structure and the amortization. What do these two conditions mean? The redemption structure simply means or simply answers the question, when will your principal amount be paid back? And a bond amortization means the regular repayment of the principal amount and the interest within the life of the bond. It's basically the process of repaying back a debt, because remember, a bond is a debt instrument. It's basically the process of repaying back a debt with using regular payments. Now that you understand the meaning of those two words, let's see the specific details in June 2022 infrastructure bond. So the tenor or the time period of this bond is 18 years. The redemption date is 2040. And now to the specifics, the redemption structure. On the redemption structure bit, it reads, 2nd June 2031, 50% of unencumbered outstanding principal amount. And it also reads 21st May 2040, 100% final redemption of all outstanding amounts. And the amortization bit, it reads, no partial redemption will be paid on unencumbered securities on amortization dates. Any amount up to 1 million per CDS account at amortization will be redeemed in full except for encumbered securities. And let's also first understand the meaning of this word, encumbered securities. Encumbered securities means these are bonds that have been used as collateral for a loan. We often hear real estate investors say that the land has encumbrances. After a search, when you go to buy land and then they tell you that the land has encumbrances, this means that the land was used as collateral for a loan and therefore cannot be transferred to a new owner. It cannot be transferred to a new owner until the loan is paid back in full. So what do these two terms and condition, the redemption structure like we've read and the amortization, mean for you as an investor? Or basically, what do these two conditions mean in layman's language? Because in layman's language, because as you can see, the Central Bank of Kenya is the best at using jargon. So this is what it basically means for you as an investor. 1, if you invest 1 million shillings or less, you will get back your full amount on 2nd June 2031. You will get back your full principal after 10 years. Okay, so basically, in a nutshell, this is a 10-year infrastructure bond for anyone who invests 10 million or less. What about those people who invest more than 1 million? You will get back 50%, or rather half, of your principal amount on 2nd June 2031. And then the rest of your money, the other 50% of your principal, will be paid back in 2040. That is simply what this redemption structure and amortization means in layman's language. Why? Well, somebody asked me, is this a good thing or a bad thing? And so it's a good thing, especially for us retail investors who often invest less than 1 million shillings in these bonds. Why is it a good thing? You get to get your money back faster. And so when you get your money back faster, getting your money back after 10 years instead of 18 years, it means you get your principal back and you can spend it or invest that principal amount in other high yielding investments such as the stock market. Second thing why this is a good condition for anyone investing less than 1 million, it's because it lowers your risk. It lowers your inflation risk, because remember that treasury bonds are not inflation adjusted. So at the moment, I'm sure you've been feeling your pockets have been feeling, or when you go shopping, you've been feeling the rising cost of inflation. And basically inflation means the rising cost of goods and services. I'm sure you've been feeling that. Is not something I have to explain to you, right? And so what happens when inflation is rising? The market value of bonds usually falls. So it's better for you to get your money faster as opposed to waiting long term. So high inflation usually affects long term bonds. So what we usually say is higher interest rates is equals to lower bond market. So it's actually a good thing for you to get your money faster, or for you to get your money in 10 years as opposed to having to wait for the 18 years. And so basically that's what it means. And so I do hope that you're planning to put some money into this treasury bond, and let me know how it goes. And make sure you feel free to ask me a question in the comment section in case there is any other condition or term in the bond prospectus that you do not understand. And my name is Agatha from the Wealth Tribe. Please like or hit the subscribe button if you liked this explanation.